Lowe's stock, ticker symbol LOW. This stock is down 90% year to date, which is quite a lot. The stock has a 52-week high of $263 and a 52-week low of $171, so that's quite a big range. From a dividend perspective, I really love Lowe's, but how about the fundamentals and the valuation? On the 17th of August, Lowe's will present quarterly results, and I think this will be a very important moment for them. In this video, I'm going to show you real quickly what Lowe's does, a view at the historical returns, the fundamental analysis, dividends, their major competitor, and in the last part I'm giving you my price target to see if Lowe's is a buy or not. And I think you definitely want to see that part, so make sure to watch until the end. And I'm also very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So what does Lowe's do? Lowe's is the second largest home improvement retailer in the world, operating 1,971 stores and servicing 230 dealer-owned stores throughout the United States and Canada. The firm stores offers products and services for home decorating, maintenance, repair and remodeling. So when we dive in the latest quarterly results, we see that they did 23.7 billion in sales, which is a minus 3.1% year over year. So this doesn't start very well. US comparable sales is also down 3.8% year over year, but gross margin has increased 74 bps, which is very good. So although revenue and comparable sales are decreasing, the margins are increasing, which is something I really like. It's the same story with the operating margin, 13.96%, which is an increase of 67 bps. About the revenue, keep in mind that during the lockdown periods a lot of people invested in the home and stuff, so it's not really likable to sustain these big growth numbers, which they had during the lockdown periods. So for me, it's not that worrying. That revenue will slow down a bit, but definitely keep an eye on this number. Comparable transactions is also down 13%, which is something that I don't like. But the comparable average ticket has increased 9.3%. And of course, this is also because of inflation. But I still like this number. And it's the same story with the online sales, which is up 2.4%. In this graph we see that home improvement market forecast, where it's expected to be a 500 plus billion market. And this looks very good to me. It is not at high rates or anything, but slow and steady, exactly as I expected. And with that being said, it's time to check the historical stock price to see what happened there. I decided to include the S&P 500 as a benchmark and HomeDepot as their major competitor. On the 5-year chart we see that Lowe's has returned a whopping 190% including dividends, which is really a lot. Especially when you see that the S&P 500 only returned half of Lowe's return, with 89%. HomeDepot is also doing very good with 129%. Both stocks did outperform the S&P 500 with a great margin. On the 1-year chart we see that Lowe's still returned a positive 9%, while the S&P 500 is at a minus 2.6%, and HomeDepot is at minus 3.6%, so that's quite interesting. On the 6-month chart we see a minus 7% for Lowe's, while the S&P 500 is at only minus 2%. HomeDepot is at minus 9%, so both stocks underperformed the S&P 500. On the 1-month chart we see some positive numbers again, with Lowe's returning a 14.7% versus the S&P 500 returning 12%. HomeDepot is at 11.7%. So does this mean that Lowe's is a buy at current prices? Let's find out by checking the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. I also want to mention that I'm almost at 1000 subscribers, so please help me achieving this huge milestone by giving me a subscribe. In return, you receive similar analysis to this one every week. So let's continue by diving into the fundamentals. Lowe's is a 135 billion market cap company with a PE ratio of 16. Which could indicate that Lowe's is undervalued. Later in this video I will give you my 3 price targets, so make sure to watch until the end. 12 trading month revenue is at 95 billion, and in this graph we see that it went up quite nice and steady back in the days. But it really took a big jump during the lockdown periods, of course. I expect things to slow down just a little bit, But still, this looks very good to me. Net income is at 8.4 billion, which gives us a profit margin of 8.9%, which is significantly higher than the 5-year average of 6.4%. So margins are increasing, which is a thing I really like. Especially since I prefer companies with a 10% profit margin or higher. But to be honest, it's very common in this industry to have lower margins, so I'm not that worried and I really like the big increase. Return on assets is at 11.9%, which is very nice of course, but return on equity is at minus 251%, which is something I don't like. So keep an eye on this number. And now the good part, return on invested capital. To me, the most important number here. It's sitting at 25%, which is really high and does comfort me a lot. Lowe really knows how to invest their money, so this looks very good. Especially since it's significantly higher than the 5-year average, so it's also increasing, which is a great thing. But a thing that I don't like about Lowe is the current debt. You want big companies like Lowe to be capable of paying down at least 50% of their total debt. And with total cash sitting at 4 billion, operating free cash flow at 8.6 billion, and levered free cash flow sitting at 5.7 billion, you have a problem, since total debt is at 33 billion. So to me, the cash to debt ratio isn't really healthy right now, so definitely keep an eye on this number as well. It's very important that free cash flow is increasing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and do acquisitions. In this graph we see that free cash flow is up quite a lot over a longer period of time, but it isn't really consistent, so although I do like the fact that it's up, I prefer a bit more consistent pattern here. But okay, as long as it's up, I'm fine for now. Another important metric for companies like Lowe are the shares outstanding. You want this number to be decreasing so your shares become more valuable. Next to that, it will be easier to maintain the dividend since less total dividends are paid, which will lead to dividend increases in the end. And in this graph we see that the shares outstanding is going down big time. So I really like this part. In the past 5 years, Lowe bought back almost 25% of the shares outstanding. This adds a lot of value to the investor. Next up are the dividends. Lowe is loved because of the dividends, and I see why. Dividend yield is pretty good at 2%, which pays you a $4.2 annually, or a $1.05 each quarter. Payout ratio is at only 26%, which is very good. This means they have 74% left in cash to pay down debt and buy back shares for instance. The 5-year growth rate is also very high at 18.7%, and they grew the dividends for 58 years in a row, which is also very good. So to me, this stock is one of the better dividend stocks in my opinion. I really like this part of the stock. Next up are the fundamentals of Lowe versus their major competitor, HomeDepot. We see that HomeDepot is by far the biggest company in terms of market cap and employees. Both companies have a PE ratio below 20, but Lowe is a little bit lower, but to me, there's no big winner here. HomeDepot has a higher year-over-year revenue compound annual growth rate and also a higher 5-year annual growth rate. But net income compound annual growth rate is increasing at an insane number at Lowe, 52%, so definitely like this part. It's the same story with the free cash flow, which is growing at 21% for Lowe versus minus 1% for HomeDepot. Both companies have similar gross margins, but HomeDepot has a higher net income margin. Return on equity is definitely higher at HomeDepot, and it's the same story with the return on assets and return on total capital. So to me, HomeDepot is the winner here. Both companies have a lot of debt compared to the cash position, so to me there's no winner here. The last part is about the dividends. HomeDepot has a dividend yield of 2.4%, which is higher than the 2% of Lowe. But payout ratio is way lower at Lowe, so that's very good. And it's the same story with the dividend rate and streak. So to me, Lowe looks a little bit better here. Overall, I think both companies are having similar numbers on a lot of things, so to me there's no big winner in general. The last part of this video will be about the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. Definitely check them out. Based on what I analyzed, I fill in 3 assumptions for every metric, starting off with the revenue growth. For the low assumption, I fill in 3% since I expect that this company will grow but not by much in this assumption. For the mid assumption, I'm filling in 5%, and for the high assumption, I'm filling in 7%, which is around the 10-year average. For the profit margin, I'm very optimistic since we saw that margins are increasing big time. So I'm filling in 7% for the low assumption, 8% for the mid assumption, and 9% for the high assumption. For the free cash flow margin, I'm filling in 6, 7, and 8%. Payout ratio is at 16% right now, so I'm filling in 15, 16, and 17, which seems fair for Lowe's. You don't want to overpay for this company, but together with Home Depot they dominate this industry and they are capable of growing. It's the same story for the price to free cash flow. I'm filling in 12.5% for my annual return, since I can get an easy 10% average annual return with owning an ETF. Right now, Lowe's is at $205 a share. I hit analyze and we see some green numbers. We have a low price target of $108 to $126, which is quite a big drop. A mid price target of $151 to $173, which is still a big drop. And for the high price target, we have a range of $207 to $233. So if you believe these high numbers, then Lowe's might be a buy. To me, the mid-range of 173 to the high range of 233 seems the most justified, since it's expected that the industry will grow at a decent pace in the coming years. And both Lowe's and Home Depot showed us that they dominate this market and know how to grow the business. My final conclusion is that I think Lowe's is a great dividend stock. I really like the dividends, and that's one of the reasons why I own this stock. In terms of valuation, I think it's not the best price right now to buy it. I won't say it's overvalued, but it's not undervalued big time either. So I'm waiting for the earnings later this month and see what happens there. I hope the stock price will come down very soon, so I might buy at lower prices. For now, I'm still bullish on the stock, but I'm looking for a bigger margin of safety before buying this stock. And remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.